You're a woman. It's the year 1750. Your husband just died. The house belongs to him. The land belongs to him. The bank account, if there even is one, belongs to him. You have 3 children. You have no money. You walk to the insurance office because somebody told you they pay out when a husband dies. The clerk looks at you across the desk. He asks for your husband. You say your husband is dead. He says, then your son needs to come in. You say your sons are 8, 6, and 3. He says he is very sorry. The policy cannot be paid to a woman. Come back when one of your boys is older. For most of insurance history, women could not sign a policy, could not collect a payout, and in many places could not legally own anything at all the moment they got married. The whole concept of insurance, this elegant idea of pooling risk, was almost entirely closed off to half the population. And the way it finally opened up is one of the slower, weirder, and more fascinating legal revolutions of the last 200 years. So how did women navigate insurance through different historical periods? And how did they go from being legally invisible to being some of the most insured customers on Earth? The answer covers 2,000 years of legal change. 3 specific laws passed between 1870 and 1882 that quietly broke open the entire industry. And one Hanseatic invention from the 1500s that quietly protected widows for centuries before the modern world caught up. Once you know the chain, you will see why your grandmother could probably not have done what your daughter takes for granted. Let's start in ancient Rome. To understand how late women got into insurance, you have to understand how early Roman law decided what women could legally do. Under Roman law, a woman was either under the legal control of her father, her husband, or, if both were dead, a male tutor who was officially appointed to make her legal decisions. The tutor system was called tutela mulierum. It applied to inheritances. It applied to property. It applied to contracts. The Romans had highly developed burial society contracts, called collegia funeratitia, where members paid in monthly to cover funeral and family payouts. Women could be members of some of these, but not all. Their access depended on whether the relevant tutor signed off. There were also wealthy Roman women who circumvented the system entirely by holding assets through trusted male intermediaries, an arrangement the Romans themselves found legally awkward. By the time the Roman Empire collapsed in the 5th century, the basic legal pattern had been set. Women existed in financial contracts, but only by going through a man. That pattern would survive, in different forms, for the next 1,500 years. Here's where it gets genuinely interesting. The Middle Ages did not improve things. English common law eventually developed a doctrine called coverture. The phrase comes from the French word for covered. Under coverture, when a woman got married, her legal identity was absorbed into her husband's. She could not sign contracts. She could not be sued in her own name. She could not own property in her own name. Anything she earned during the marriage automatically became her husband's. The legal phrase was femme couverte, the covered woman. This was the standard law in England, the United States, and most of the British Empire well into the 19th century. Now here is where the story gets actually fascinating. In northern Germany, the Hanseatic League cities, especially Hamburg, Lübeck, and Bremen, started building something different in the 1500s. They created funds called Witwenkassen, or widow funds. Members of craft guilds paid annual contributions. If a member died, his widow received a regular payout for the rest of her life. It was not technically a policy in her name. It was a guaranteed obligation that the guild could not avoid. For a widow in Lübeck in 1550, this was genuinely revolutionary. Honestly, kind of beautiful. The northern German cities, the same cities that built the first fire insurance and the first formal cattle pools, were also quietly inventing the first systematic financial protection for women. Now here is where things get really wild. By the 17th and 18th centuries, life insurance was a real industry in London. William Gibbons, the very first documented life insurance case in 1583, was insured under a policy held by a man, paid out to a man, and litigated by men. The Amicable Society for a Perpetual Assurance Office, founded in 1706, mostly insured men. The Equitable Life Assurance Society, founded in 1762, was scientific, but its early customer base was almost entirely male. There was no legal mechanism for a married woman to insure her own life or her husband's life and keep the payout for herself. Even if a policy was clearly intended to benefit a wife, the money technically passed through the husband's estate, which meant his creditors could grab it first. Before we go further, a quick, honest note. The legal picture and the family picture were often two different things. The husbands loved their wives, worked hard for them, made careful wills, and left them protected. Fathers set aside money for daughters. Brothers looked after widowed sisters. The Hanseatic widow funds were built entirely by men who wanted their brothers in the guild to know their families would be safe. Even coverture, the doctrine we are about to talk about, cut both ways. Husbands were legally obligated to feed, clothe, house, and protect their wives, and were responsible for their debts. The system was asymmetric, but it was full of men doing right by the women in their lives, quietly, for centuries, in every generation. That is the human story underneath the legal story. But a widow could be left with nothing even when her dead husband had paid premiums her whole life. 3 pieces of legislation finally fixed this. In 1870, the British Parliament passed the Married Women's Property Act in England and Wales, allowing married women to legally own their earnings. In 1880, the Married Women's Policies of Assurance Act applied this to Scotland, with the specific addition that a woman could now buy a life insurance policy on her own life or her husband's life in her own name, and the payout would belong to her, free from the claims of his creditors. In 1882, the Married Women's Property Act was extended in England with the same insurance provision. In the United States, similar laws started passing state by state, beginning with Mississippi in 1839. Slowly, jurisdiction by jurisdiction, the legal fiction that had absorbed women into their husbands for 1,000 years was dismantled. For the first time in recorded history, a wife could put her own name on a contract that paid her when her husband died, and nobody could take it away. Here is why all of this still matters. The dismantling of coverture and the integration of women into the insurance industry did not just change individual lives. It changed the entire scale of the insurance business. By the early 20th century, life insurance companies in Britain and the United States started writing policies for both spouses on a routine basis. Today, women buy more life insurance, more pet insurance, and more household insurance than men in many markets. Women also tend to live longer than men, which means actuarially they are some of the most profitable customers any insurer can have. Until 2012, European insurers were legally allowed to charge women different premiums than men based on their longer life expectancy. The European Union banned that practice in the Test HATS ruling, requiring gender-neutral pricing. The same industry that once refused to write contracts for women now lobbies actively to keep their business. Honestly, the reversal is something. 300 years to go from invisible to indispensable. So when a woman walks into an insurance office today, signs a form in her own name, names her own beneficiary, and walks out with a policy that nobody else has the right to touch, she is doing something her great-great-great-grandmother literally could not do. She is using the legacy of those 3 British Acts in the 1870s and 1880s. She is also using the legacy of the Hanseatic widow funds that quietly protected widows in Hamburg 300 years before that. The Roman Tudor system is gone. The doctrine of coverture is gone. The widow at the desk in 1750, holding 3 children and no money, is gone. The policy she could not sign is now signed routinely, every day, in offices and on phones around the world. It is strange to think how slowly something this simple actually changed. For most of the history of insurance, half the population was sitting in the waiting room. Roman law kept them there. Medieval coverture kept them there. The Hanseatic League cracked the door open. 3 British statutes kicked it down. And the modern industry, after centuries of writing them out, eventually realized that women were not a problem to be managed. They were a market. There is a deep lesson in that. The same legal system that excluded a group of people for 1,000 years did not change because anyone had a sudden moral awakening. It changed because eventually it became economically irrational to keep excluding them. The premiums got paid either way. The claims got filed either way. The math worked exactly the same regardless of which spouse signed the paper. The walls that locked half the population out of the insurance market were not actuarial walls. They were just walls. And once Parliament stopped propping them up, they fell faster than anyone expected. The clerk is gone. The desk is gone. The widow is gone. The policy is still here.